Hey there, and welcome. Today we're going to dive into a massive question in the crypto world. Why on earth do the prices swing up and down so much? In this explainer, we're going to break it all down for you, nice and simple.
Have you ever pulled up a price chart for a cryptocurrency and just thought to yourself, wow, that looks less like a financial asset and more like a roller coaster? If you have, you are in exactly the right place. We're going to figure out what's really going on behind that chaos.
Okay, first things first. There's one word you're going to hear a lot, and that's volatility. Now, it sounds kind of technical, but it's not. All it means is how fast and how much a price changes. And in the world of crypto, high volatility is pretty much the name of the game. So to really get a grip on this volatility, we've got to start with the engine that drives any price for anything. I want you to picture a simple seesaw at a park, because believe it or not, that is the core mechanic, and it's all about balance. Think of it like this. On one end of our seesaw, you've got supply. That's just how much of a coin is out there. On the other end, you've got demand. That's how many people actually want to buy it. The price you see is simply the balancing point between those two forces. And here's the thing. It's the changes in demand that really get that seesaw moving. When not many people want to buy, the demand side gets lighter and the price naturally tips down. But when everybody wants to buy, that demand side gets heavy and whoosh, the price tips right up.
Okay, so let's picture this for a second. Imagine a coin has a set supply, but, not many people are really all that interested in it. With that low demand, the price just kind of sits there. It's low, it's stable. The seesaw is barely moving.
But then, what happens if, all of a sudden, everyone wants to get their hands on that exact same coin? The supply is still the same, right? But the demand just skyrockets. That massive surge in people wanting to buy sends the price through the roof. That seesaw isn't just tipping anymore, it's launching into the air.
Okay, so that leads to the really interesting question, what causes demand to suddenly explode like that? Well, this is where we add the secret ingredient that turns our simple seesaw into a full-blown roller coaster. And that ingredient is us. It's the human element, what I call the hype machine.
A huge driver of this hype is an emotion I guarantee you've felt before. FOMO, the fear of missing out. When people see a price shooting up and hear stories about others making a ton of money, that fear kicks in hard. It makes you feel like you have to jump in right now, just so you don't get left behind. And that FOMO can create this incredible snowball effect. It often starts with just one little thing, some good news or maybe just a rumor. That sparks a little buzz online and the first buyers jump in, which causes the price to tick up. Then the news reports on the price spec, which gets even more people interested, and the cycle just feeds on itself, pushing the price higher and higher. All right, I know this can all sound a little theoretical, so let's make it super real. Let's walk through the story of a made-up currency we'll call example coin and see exactly how this hype cycle plays out.
Okay, so here's our coin, example coin. It's new, pretty unknown. But then one day, out of the blue, a massive celebrity tweets to their millions of followers that they think example coin is the next big thing. And that one tweet, that's the spark.
And just look what happens next. On Monday, example coin is just $1. On Tuesday, after that tweet, FOMO goes into overdrive and the price jumps to $10. By Wednesday, news outlets are all over the story, a flood of new buyers pour in, and the price explodes to $100. But then, Friday comes. The early folks decide to sell and take their profits, which causes a panic, and the price completely crashes, all the way back down to $5.
Think about that for a second. At its absolute peak, it hit $100 a coin. That's a 100 times increase in just a few days. And it wasn't driven by some new technology or feature. It was driven almost entirely by hype. But what goes up that fast? Well, it can come down just as fast. The hype machine has a flip side. As soon as a few people started selling, the fear shifted and the price collapsed, wiping out a ton of value, and unfortunately, leaving a lot of the later buyers with some pretty big losses.
Okay, so this probably has you wondering, right? If this is all just supply and demand and human emotion, why don't we see the stock price for, say, a huge company like Apple do this every other week? It's a great question. But when you put them side by side, the differences are pretty stark. The stock market has a ton of regulations, things called circuit breakers that can literally halt trading if there's a panic. Stocks are also backed by real-world things like a company's profits and assets, and trading only happens during business hours. Crypto? It's pretty much the opposite. It's mostly unregulated, its value is backed by belief in its code and community, and the market is open 24/7 all over the world. That makes it way more sensitive to pure hype. So let's just tie this all together.
The real reason crypto is so volatile isn't just one thing. It's kind of the perfect storm. You start with the simple mechanics of supply and demand. Then you add a huge dose of powerful human emotions like hype and fear. And you mix it all together in a market that's young, global, always on, and has very few rules. That's your recipe for volatility.
So, now that you can see the why behind all these wild swings, it leaves us with a really interesting question to think about. What does all this volatility, the good and the bad, really signal about the future of these digital assets? Thanks for joining me for this one.